Today's topic we are going to discuss is GAAP. What is GAAP? It is generally accepted accounting principles. In accounting, we shall follow these principles. Why should we follow? Because to maintain uniformity and consistency. We have to maintain uniformity and consistency in maintaining the accounting records. All the transactions that has been recorded should be uniform and it should be consistency, the methods or the policies that the company is following. Then there shall be GAAP principle being applied, which you are supposed to follow. Now we have certain basic concepts and conventions that you're supposed to follow. All the concepts will be discussed. Concepts of principles and conventions. The first concept is business entity concept. Business entity concept. Here, the owner is different and the business is different. There are two people. All the transactions should be recorded in point of view of business and not in point of view of the owner. Any transaction that is taking place which is related to the business should be recorded in records of the business. Because it has separate legal entity. Business is a separate legal entity. That's why we record all the transaction in point of view of business. Next, we have money measurement concept. Here, why are we not taking any personal expenses or income shall not be considered when recording any transactions. Next is money measurement concept. Any transaction that shall be taken place shall be measured in terms of money. There is exchange of goods and goods. No, barter system is not allowed. Any transaction that has taken place should be considered in terms of money. Next, we have going concern concept. Usually business is done for a long period of time. There may be people coming in, people going out in the business, but company will go on unless it is legally dissolved by the people or the partners or the shareholders or court which will dissolve the firm. Next concept is accounting period concept. In India, as per Companies Act 2013, we follow financial year. Financial year is from April to March of next year. There is a calendar year. There is calendar year from Jan to December. But we follow financial year April to March. Any transaction between this period, in this period, shall be recorded in books of accounts. Next we have is cost concept. Cost concept, the transaction anything taken place will be recorded on the original price or the cost price. It is also known as cost of acquisition. Example, now we have bought machinery. We have purchased machinery. We have purchased it from the business is in Bangalore and purchased machinery from Hyderabad. Then there will be transportation involved. Yes. Then we have to install that machinery in Bangalore office So installation will be there. For installing, we should get people, recruit, or we have to take on a consultancy basis. Then we have to pay wages or consultancy fees. So all these price, machinery is 1 lakh, transportation incurred will be 20,000, installation is again 30,000, consultancy fees paid is 30,000. 30, you have to add together 1 lakh plus 20 plus 30 plus 30. 1 lakh 80,000. So, in books, we shall record purchase of machinery as 1,80,000. This will be the cost of acquisition. And it has to be recorded on this price, cost price. Involving all these other expenses also, because the machinery bought till machinery is put to use, the expenses incurred shall be considered as cost of acquisition. Next, we have dual concept. In financial position, we learnt about assets and liabilities. Assets plus liabilities, and we also learnt in other basic terms what is capital. So assets will be equal to liability plus capital. And here, suppose we will see one example in dual concept. Asset should always be equal to your liability and capital. There can be no excess asset or decreased liability. Always there should be an equal. Suppose a amount has been invested in a company. Amount invested 1 lakh. So amount invested, there is cash coming inside the business as what? He is invested. So it will be capital. Cash is an asset. Capital is a liability. Otherwise, if there is purchase of machinery, the same. What is coming inside is machinery. What is going outside? Cash. You're paying them. So cash is going outside. Machinery is come inside, which is increase your asset value. Cash is going outside, it is reduced your asset. To journal entry, dual concept. Machinery and cash. Here, cash and capital. Next we have is matching concept. In matching concept, first of all the transactions should be recorded. During the accounting period, whatever the transaction is entered, you have to record it in your accounting period. Should be recorded in books of accounts. And how do you get profit? Your revenue minus expenses, you will get profit. Or if there is more of expense and less of revenue, you tend to get loss. Matching concept. Next you have is consistency concept. What is consistency? There should be uniformity in the policies or accounting conventions that has been applied in the business for recording the transactions. Because based on this consistency, based on the policies being followed, you can draw conclusions. Okay, what is happening in the business? Next we have conservatism. Or it is also known as prudence. Here, all the losses that shall be occurred shall be recorded. What is the possibility of losses shall be recorded. And it shall be future losses that the company is expecting. But future profit will not be recorded. Why? Because it is uncertain. Income shall not be recorded, but any losses shall be recorded. Example, we learnt about debtors, correct? Debtors are the people where they have to pay money to the business for the service or good that is availed by the person or an individual. Suppose the debtors is become bankrupt, or he is not able to pay money because he doesn't have it. Then you record provision. Example, provision for doubtful debts. It is possibility of losses that the business might occur in future. So I am recording it in the books of accounts. Next is materiality concept. And in materiality concept, all the facts related to business which are material shall be recorded. Suppose the company is entered into an agreement with the party for purchase of land which is worth of 2.5 crores. The agreement is entered and it has become legal. Now he has to purchase. That material fact agreement was not entered in the books of accounts. The amount of 50 lakhs is being paid as an advance. Where is that advance 50 lakhs? So all the material facts has to be recorded. Next, all these accounting concepts is being done. Next, accounting has to be prepared on cash basis or accrual basis. System of accounting. Whether it has to be done on cash basis or it has to be done on accrual basis. On cash basis, any transaction that consists of cash will be recorded here. Suppose we have purchased goods from X for rupees 10,000 on cash. You will record the entry. Suppose sales made to X for 20,000 for on cash basis of accounting. Suppose sales made on 20,000 on credit. This entry will not be recorded here in cash basis of accounting because they tell only what the cash is coming inside, what the cash is going outside. Only those entries shall be recorded in cash basis of accounting. But in case of accrual basis of accounting, any transaction that has taken place during the accounting period, it might be cash basis accounting period, it might be on cash basis or credit basis. Then it shall be recorded in books of accounts. Example, rent of building is paid on 10th of subsequent month. Now March month rent shall be recorded in the month of, he will pay on April 10th, but the rent pertains to March. March is an accounting period end. So whatever the rent amount, it might be 10,000. So you will record outstanding rent of 10,000. This is for accounting period. That's why I'm recording it in the books of accounts in the current period. In the upcoming videos, we will see next golden rules of accounting and accounting equation. Okay, let's see golden rules of accounting in the same video. Golden rules of accounting which shall be followed. There are 3 accounts: real account, personal account, and nominal account. Real account, the rule tells debit what comes in, credit what goes out. In personal account, debit the receiver, credit the giver. And we have nominal account, debit all your expenses and losses, credit all your incomes and gains, incomes or gains. In real account, It is all about your assets. Asset what comes in, asset what is going out. Here it is all about persons. Normal account is all about your expenses and income, which is being recorded in profit and loss account. We have to see examples on this, and this. Okay, here asset and liability. We'll see one example of real account. Purchased machinery or purchased building. Purchased building, what is coming inside? Building is coming inside. What is going outside? Cash is going outside. Suppose if it is not made on cash basis, it is on credit basis, then it shall be excess account or vendor's account. This is an asset, this is a liability, which I will have to pay in future. Personal account. Example, salary being paid. Who is receiving? Employees. Who is giving? Business is giving. Expenses in nominal account. Expenses will be salary, rent, commission, goods purchased, all your recurring transactions, recurring expenses that is being incurred by the business to produce this income. Sales, sale of good or service. Then other incomes. Other incomes will be interest, dividend, royalty. All these are other expenses. So here I shall give you some of the accounts which shall be classified into real, personal and nominal, which you can go through it. Thank you.